And here he is, Nicholas Frappell, Global General Manager of ABC Bullion, talking all about the risk on, the risk off, and risk altogether. Nicholas, over to you to tell us what's going on with gold.
Thanks very much, Kerry. Good day, everyone. I'd just like to thank Kerry for the opportunity to speak here today. Look, this has been a really incredible year for many, many reasons. And, we're reopening after the sort of shock of COVID, and we're dealing now with the huge growth effects of the monetary and fiscal boost given to various world economies in order to sidestep or to get over the problems with COVID. And what that's led us to is really an incredible year in terms of year-to-date performance in equity markets, double-digit growth in mainstream markets. We've got incredible performance in crypto. Canine crypto is a whole subject all by itself, and people have made fortunes there. But what we've seen is we've also seen YOLO and meme investing. We've seen certain trades, everyone's familiar with GameStop and so on, where some pretty savvy investors have put the squeeze and seen tremendous rewards. It's a little bit of a new world, and we've seen all kinds of things going on. But what's really interesting is that despite having some really positive projections for gold and some pretty negative projections for the dollar and dollar index at the end of last year, which we could treat as being gold bullish, gold didn't hit the upside targets, the ambitious upside targets widely predicted by institutional analysts at the end of 2020, beginning of 2021. We saw an estimated, if the year carries on as expected, Bank of America expects an enormous potential $1 trillion inflow into world equity markets on an annualized basis. And what we're seeing, if you look at the VIX index, which is the expected volatility of returns on the S&P 500, is we're seeing low volatility so far this year. At any rate, the year is very much all but done. What we're seeing is an environment which has been largely risk on and embracing risk, fearless investors, and that has not been an environment that really is satisfactory for gold. So that's the first thing. This year, it's about risk on. That may change, of course, absolutely. But if you're looking at January to Nov, it's the risk on year, disfavoring gold, certainly up until November. And if we look at what investors actually did, and the first slide I'm going to show you is what investors did in worldwide ETFs, is effectively they left the market for other opportunities. November, this time last year, global ETFs were about 111 million troy-ounces, and now we're around about the 98 million level. And even the last week, where we've seen a really lovely breakout, a very positive breakout for the gold bulls, we've not really seen yet, or certainly at the time of writing, really sharply renewed interest in the ETF space. What about gold positioning through what investors hold in the CME, which is a good proxy at looking at what investor appetite is? Now, looking at the year from November of last year to this year, we've seen the market really moving in a range in terms of position. November last year, managed money longs 14 million ounces. As of the 2nd of November, barely 100,000 ounces more than that. There's a little bit to unpack in this chart, so I just want to show you a couple of things so you know what you're looking at. The lines on the upside, the bars, that's people's long positions. Below the dates, that's their short positions. You can see both haven't really changed a lot. The blue horizontal line, about 11 million ounces, that's the average of the net position for the last 15 years. So you can see from looking at this slide that net positioning, which is the jagged gold line that runs through the middle of it all, that only troubled the average for, I believe, 1 week of the past 12-month period. Below that, the net position has traded below that for pretty much the whole of the last year. So that tells you a lot about where investors are at in this space, where their heads are at in terms of what is gold, how much do we want to be exposed to it. You can see it that the 11 million average compares with early November 8.63 million. That's where investor net positioning lies at the moment. So that's telling you what people are actually doing. They might be saying all kinds of things, but this is what they're actually doing. So what happened? And it's worth just looking back just to say we've addressed the fact that we live in a risk-on world. What happened to the dollar? The dollar was supposed to go down, and there were some reasonable reasons why people thought that, to do with deficit spending and so on, to help pick the American economy up. But it didn't do that. And there are three reasons for that in my mind. The first thing I'm going to deal with is that the net short in dollar positioning and the dollar index positioning, taking the dollar as a composite in January, was extremely low. And every time it's the low, and it has been that low 8 times in the last 2 decades or so, you get a pretty profound rally afterwards. Also, analysis of the cycle of the dollar suggested a rally, and the yield differential favored the dollar. The American economy threw so much money at getting out of this problem, they were almost bound to outstrip the rest of the world. So there's your quick take on dollar index net positioning. If you look at that red box down towards the right-hand side, you can see that this is a pretty major short positioning. That short positioning is turned around, and you can see the blue line, which is the DXY, moving sharply higher. It may be slightly hidden behind Kerry and I, but we can share these slides. US dollar yield premium and the rising dollar. That black line is the US dollar interest yield premium over and above other G7 economies. You can see it's rising and rising. It's a jagged line, but it's rising. And the dollar index in red is basically following it higher. And that wouldn't have been a total surprise when you just saw, well, A, the American economy is pretty vigorous, and B, they dug deep to get out of this problem. So the last thing I just want to mention, US dollar following a 39-month cycle, more or less. It's not perfect, but look at where the last gold line was that falls through pretty much the last major low. We intercepted the bottom of a cycle. There were good reasons to expect that this cycle behavior, which has been pretty robust in the past, would play out again. So those are my 3 reasons for why I expected a dollar rally, which was going to be a headwind for gold. Didn't say that gold had to be lower, but it was going to be a certain headwind for gold. So I want to move on now to inflation, because everybody is talking about inflation, and it's a pretty good way to put yourself in the firing line if you sort of suggest inflation is one thing but not another. Look, the first thing to say is clearly there's a lot of supply-based inflation, supply line-driven inflation. The COVID massively disrupted supply chains. It snapped and broke supply chains. That reopening phase, there's been a long struggle to cope with reopening. That's been compounded with weather effects, particularly in the Gulf, which has had big effects on nat gas and the ability to process energy. Obviously, that's a big component of the inflation index. In Europe, it's been more of a political issue. But what's important is that upstream disruptions have really important spillover effects that affect downstream products that might ordinarily not at all be affected by inflation or supply problems. Regional effects are very, very pronounced. If you look at the sector for shipping from China to America, that's a completely different story cost-wise to sectors in other parts of the world. But what we do know is that the Fed's relatively new flexible average inflation targeting regime is being put under the test. There's a couple of things I want you to take note of, and I'm going to show you in the next slide. And that is this, is supply-based inflation very much here. How long it will go on, I can't say. But look at these next 2 slides. Baltic Dry Index,
wow,
which is the shipping, the cost of shipping, absolutely plunging, and is absolutely plunging at the fastest rate since the GFC.
wow.
The slide on the right panel, Chinese credit impulse. Chinese deleveraging, very much in the news because their property sector, that is declining into negative territory as fast as any time since the great sort of input of credit that they did to prop the economy up since the GFC. So just take note of these 2 things. There's other things as well. There's collapsing consumer confidence in the States as far as I see it, but I've just charted these 2 things. because they tell you a lot about how things may pan out in the next year. The other thing I wanted to talk about just briefly is that very contentious issue, and you see this a lot in sort of Twitter and social feeds and so on, where you see people saying, money supply exploded last year, inflation should explode with it. And I just want to touch on this point really quickly, because it's much more nuanced than that, of course. The velocity, this is US money supply, M2 money supply, plotted with money velocity, and also the purple line is the US nominal growth. So when you look at this, yes, M2 snapped higher, money velocity snapped lower. Those two things offset each other hugely. If you look at the numbers, then since the reopening and since the sort of, if you like, the worst days of COVID in economic terms, the US economy has been growing again. That's the right-hand side of the Fisher equation. So that too is an offsetting element in this whole money velocity equals price times nominal GDP. So that's the thing. You've got to look at it in its totality. Just saying that money supply did this and it's crazy and it's off the charts. Yeah, fair point. But there are other cogs in that wheel. So I just wanted to mention that point, because I'm sure that nobody listening in is doing this, but some people do. So the other thing is, the next thing I want to draw onto is Chinese US dollar high yield bond yields. And as you can see, they're ripping higher. The Chinese high yield bond market is absolutely being smashed, both onshore and offshore. It's not just an onshore phenomenon. So what does this mean for gold? Well, China is obviously the second largest economy on the planet. What this is telling me is that a large part of their, a significant part of their economy is naturally going to have to refinance through the rest of this year, into next year, and actually beyond. And if this position with very, very expensive money persists, as those economic entities, as those businesses come up and they need to refinance, they're going to find it extremely expensive. Some of them will find it too expensive. This, unless it's dealt with, unless something changes, and at the moment we're not seeing signs that it will change, we're talking about bankruptcy and shrinking economic growth. So that's something that you have to bear in mind when you look at, for example, we've been talking about supply chains and the impact of supply chains, and if you like, demand being too high for the supply chain capacity. Well, this is telling me that next year could be a rockier year, certainly for China. And if it's rockier for China, that's rockier for world demand. So that will feed into, my summary about how that affects gold, but you can't be sort of unaware of what's going along. And look, the thing is, one doesn't want to over egg this too much, but the property sector, which so much history, if you want to look at a first-rate financial crisis, the property sector is always either at the epicenter or it's lurking right next to it. This is what's going on here, and a lot of Chinese high yield is about the property sector, which is roughly a quarter of China's economy. So this is a huge issue. We don't know how it will pan out. By the way, what would happen? What's the flip side to this story? What if the Chinese state, the People's Republic, said, "Hang on, this is actually too big to fail. This is too much of a problem. We're going to step in," and they are tweaking. There's no doubt about it. There's evidence that they're tweaking, but they're only tweaking. What if they step in and they actually take more aggressive and concrete action, which they clearly don't want to do? But that inevitably means a string of other problems. It means more Chinese debt, and there's a lot of that. It means lower Chinese productivity, and that's been falling. And it means more moral hazard within the domestic economy. And that's all of the things that deleveraging was supposed to avoid. It was supposed to get ahead of that particular freight train, if you like. But the problem is the problem already was perhaps too large to deal with in any kind of smooth way. So potentially a weakening of activity, more volatility, and a more likely return, if there's less demand, to the kind of lower rate environment that is good for gold. So just back to our old friend, gold and real interest rates. I'm going to show you this to you in two ways, just because, you know, people like to see it twice. Real interest rates, you know, falling again. This is over a substantial amount of time, almost 15 years. You can see that gold is mirroring the decline in real rates pretty well. And this is a shorter term, perhaps flipped it around to, you know, some people like it looking at it this way. This is showing again the persistence of real interest rates as a really good explaining for the gold price. Some people would say that real interest rates, this is understating real interest rates, and they may have a point. There are two reasons for that. One reason is that I'm using Treasury inflation-linked bond yields to tell us where real interest rates are. Well, that's a pretty small market actually compared to the nominal, the big sort of universe of US Treasury bonds. So that's probably, that liquidity issue is probably overstating, if you like, the real interest rate, making it look too high. The other thing is there's a bit of an indexation lag of about 2 or 3 months. So possibly there. So some people will say real interest rates are truly lower. If they are, that's of course even better for gold. Now, just want to give a hat tip to Charlie Morris here, credit for this chart, Bytree Asset Management. It's a very robust and reliable look at fair value, where gold, the fair value of gold. You can see that gold's kind of like gone a little bit ahead, but the latter part of this year has been about gold declining, finding support at the fair value level. So gold at current levels, certainly according to what I believe to be quite a reliable and scientific index on fair value, gold is certainly fair valued, and that feeds into my summary. What about targets? Well, targets here, and I know the numerals are a little bit smaller, but it gets pretty ugly if you try and explode the font. But we've got a lot of upside targets. Gold has done extremely well lately, but I'll just give you an idea of upside target on this sort of medium to longish term chart, almost 2100, about 2090. Certainly pattern charting suggests 1950, but the longer term chart still suggests 2180, even 2340. Which I think for a lot of gold bulls is not a particularly dramatic take on where gold can go. So, you know, I'm not going crazy here. But again, you can see from the past history of this chart that levels where it is suggested gold can go on both the upside and the downside are, you know, entirely plausible. Where gold is at as of today is just below a key resistance level at about 1873. Does need to get through that level, but I think it performed extremely well last week when it broke up above 1835. If you want to look at the kind of the macro view on or I should say the micro view on where it is. So what does this mean for gold in late 2021 and through 2022?
2 minutes, Nicholas.
Yes, and I'm almost there with you. The world, yeah, it's experienced inflation, and that's exaggerated by supply chain issues. It may prove to be somewhat transitory, defined transitory, of course, but that will depend very largely on whether labor and other expectations don't become unhinged. Markets are expected to tighten faster than communications coming from the Fed, the ECB, and certainly the RBA. The question is, do central banks converge on market expectations? I suspect they will. Markets appear to be curve flattening, which suggests that we're at the end of the growth cycle, the current growth cycle. And what I expect may well happen is that the persistence of inflation will cause tightening, will cause central bank tightening sooner than they expected. And you will find it's possible then that there's a policy error and that inflation proved to be shorter lived. Hard to make that call, but I think we will see a world where the markets tighten, central banks tighten more sharply and more sooner than we expected 10, 12 months ago. And then afterwards, we will return to a lower rate environment and a lower growth environment, which will favor gold. and we are past the best of the earnings and so on, and the risk on, we will then transition, if you like, to a lower growth, more risk off environment. So that's in short, and just within 20 minutes, my reasons for where we are now and my largely bullish take on gold going ahead.
And thank you very much. And it would be remiss of me not to mention that thank you to the support of ABC Bullion. We've been able to bring you a fantastic day of speakers and commentary. If you'd like to find more about ABC Bullion, go to abcbullion.com.au, and there you can find some more information from Nicholas as well. Nicholas Frappell, for now, we'll see you at the end of the day in the Zoom networking where people can ask lots of questions. But thank you for being our opening for the Virtual Gold Conference today.
Thank you very much, Kerry. It's been a pleasure.